Hello, chart watchers, and welcome to this Wednesday, July 17th, 2019. Wow, I can't believe it's that far. MarketWatchers live show with your host, Aaron Swinlin, and guest co-host, Mary Ellen McGonigal. For those of you joining us for the first time today, welcome to the show. And for our regulars, of course, welcome back. All right, let's take a quick peek at what's going on in the market right now. As you can see, we're up slightly for the Dow Industrials, up just a little over 5 points. S&P 500 had a really rough slide this morning, but is making up, it looks like almost half of the losses it took earlier. NASDAQ, very similar, down about 22 points. The NYSE, as you can see, we're getting that lower low, and now we're starting to bounce right back up. And then we have the S&P 400, as you can see, moving to the upside after falling to test that closing price of yesterday. Russell 2000 on the positive side, really like to see all of that action to the upside above the zero line. Treasury yields are higher right now, reading at 2.118%. VIX is slightly lower, 1267. The dollar is up, nice gap, and now consolidating. Gold, a little bit of a rocky morning, fell all the way down to 132.25 for GLD, but has taken back most of those losses and is at 133.17. USO, wow, took a dive in the last 20 minutes here, and we're seeing some issues going on. We've got the TLT is down lower as well. And now I'm realizing that I don't know that I have there we go. All right. And away we go. Mary Ellen, welcome.
Yes, thank you. Good morning. It's Wednesday. We're almost halfway through the week, and the markets are seemingly in a go-nowhere overall environment, but it's nice to see them making up their losses on the day. It's encouraging.
Yeah, absolutely. We'll see if we can't get back over to the positive side there. Russell 2000, by the way, I read that wrong. It is down 0.25% right now. So I was hoping to see those small caps doing better, but actually looking at the list of indexes from our front page, it does look like it is down the most right now. So not good to see. Would like to see better coming out of the small caps. All right, but we have a very special guest today. Martin Pring is here with us. How you doing, Martin? How's the weather out there?
In Florida, it's pretty good today. Pretty good. Not too much rain.
Well, we're super excited for your presentation, and we will bring you back in about 15 minutes. Does that sound good?
Okay, look forward to it.
All right, excellent. Okay, Mary Ellen, let's go over the schedule and agenda.
Yeah, you bet. So we've had a wonderful week so far. Martin, of course, is here with us today. We look forward to hearing from him. Tomorrow, Julius de Kempenaar will be here. And next week, we've been talking about this quite a bit, but it's really going to be interesting. It's relative strength week. And relative strength, of course, paying attention to that metric is really powerful. It'll make a difference in your work. So we have several experts joining us next week. On Monday, Mark Chaikin from Chaikin Analytics will be here. Gaddis Rose, of course, and Arthur Hill, Julius de Kempenaar on Thursday. And on Friday, David Keller will be joining us. And each of those last gentlemen are, of course, from StockCharts.com, so don't miss that. Today, we have a lot to cover. We're going to be listening to Martin talk about long-term momentum. Very, very compelling. From there, we're going to be doing the 10 in 10. So go ahead and get your stock ideas in there. And sector rotation is going to be pretty thematic today with our work. We're going to be doing a lot of interesting analysis there. And then, of course, we're going to end it with the Scooter report. That's the StockCharts Technical Rating. And that will wrap it up.
All right, looking pretty exciting. I guess I'll take it from here, and we'll just start off right away with the key economic reports. And we had two that came out today. Economists are a little concerned. Housing starts were down 1.253 million versus 1.244. It's less than they had expected. Honestly, it looks like that we did move seasonally adjusted rate. So they were expecting at least that. The permits, I think, is what's really bothering people. We had 1.220 million versus 1.3 million. And, the problem is when, we're looking at these permits, they sank to 6.1%, and they actually are at the lowest level since the mid 2017. So, we had these lower interest rates, which we were expecting to help with the housing market, and we're really not seeing the kind of numbers we wanted out of that. Let's go ahead. I'm going to move on to our key earnings reports. And as you can see, quite a few. We actually have 2 pages worth of them, and I'm going to go through some of these top ones for you. Yeah, we had most of them came in as expected. I would say the misses that were kind of painful would be Erickson. They did report 6 cents versus 7 cents, and that does seem to be affecting that stock. We'll look at that one. And if you go to the next page, I believe there was another earnings miss in there. Yes, and that would be Comerica. They reported $1.94 versus $2.01. So those two are really taking it a little bit on the chin. Let's go ahead. I'm going to bring that up for you, and we'll take a more deep look at those particular stocks. So Erickson was one, and Comerica was the other. So let's go ahead. I'm going to just go ahead and start with Comerica. Go CMA. There we go. So as you can see, really tough day in the market for Comerica, down over 3% on that earnings miss. The PMO had already started to bulk right there at the 0 line, and now it has turned down below the 0 line. Looks like we might get a PMO sell signal. The only thing I could say that really is positive, though, is we were seeing a rise in the rising bottoms in the OBV, and you can see that the price was in the shorter term, those bottoms were moving lower. So the expectation, at least with that positive divergence, that positive divergence would have been an upside move. But, this is why we talk about when you have a stock that's in a bear market configuration, just like Comerica is right now, when it has that really high margin between the 50-day and 200-day, with that 50-day being that far below the 200-day EMA. I mean, that tells you that that stock's been downtrending for quite some time. You can even see back here in March that the 50-day EMA was making that move toward the 200, but failed and turned back down. So I personally stay away from stocks where the 50 is that far below the 200, unless, that's sort of what I'm looking for as a beat down stock. But typically when I go to trade, I want to see that 50 above the 200 because your chances of success are a lot higher. And I would say this is proof, that's proof to that point. All right, Erickson also had that earnings miss, and boy, it's really taking it on the chin here, down over 11%. You can see that price had been at least closing above that 20 and 50-day EMA, and today it just fell like a rock below that support level that looked like it would have held up at $9, but now we are moving down to test some of these lows right around the $8 to $8.20 level. That would be the next area of support. We might see a little bit of a bounce back here after this big deep decline. I mean, if you're a super short-term trader, might consider it, but honestly, I don't play that kind of trade myself. All right, let's look at Abbott Labs. This one was upgrade. Like I said, this one was had a nice earnings move there. And you can see we're getting a 3.82% move to the upside. You like to see that overhead resistance being broken on the gap. You've got the PMO turning up. I think that's very healthy at this point. And we do have a scooter that's just now moving right back up into the hot zone. I believe it is one of our top scooter movers today as well. Last one I'm going to look at is Progressive, and then we'll look at some of the major market, what's going on there. All right, so Progressive, we actually didn't have an earnings miss, but I suspect they didn't meet revenues or top line versus bottom line. I didn't have a chance to research that, but we do see a big move to the downside. We're trading now, if you look in that thumbnail, below the 50-day EMA. You know, this is a really good setup as far as the trends go, you know, with that kind of margin between the 50 and 200 to the upside. And of course, the 20 is well below the, well above that 50-day EMA as well. But on this move, we're losing the scooter, and it has moved out of the hot zone, as I call it, which is a reading of 75 or above. And of course, pretty ugly PMO right now. Not looking too good here for Progressive at this point. All right, I wanted to just look at a couple of my regular decision point charts. You'll find these in the Decision Point live chart list. I do go over these also in the Decision Point show on Fridays at 4 p.m. Eastern time. So you can tune into that. But let's go ahead and look at the relative chart. I wanted to show you pretty much, this is giving you the relative strength, really, the relative to the S&P 500 of all of these major indexes. And really what you can note is that the Dow is starting to perform much better than the S&P 500 with that relative strength line moving up there nicely. We've got relative strength on the NASDAQ 100 and really the OEX still trending higher. The problem that I have here right now are the S&P 400 and 600 relative charts here. You're continuing to see a decline. Yeah, Mary Ellen, you're laughing.
Easy for you to say.
Easy for me to say, not quite. But we're seeing the S&P 400 and 600 relatively still mostly in a decline. You know, we've hit some relative lows here on the S&P 400. I would have hoped to have seen it finally start to bounce out. We had at least seen a higher low slightly on the S&P 600 relative low. So, you know, I'd like to see that starting to improve. That's generally what we want to see in the market. Is those mid and small caps participating in any upside move, and we're just not seeing that right now. When you look at the broad market indexes, in general, these are the price charts for the ETFs that we cover here. We've got the SPY as our S&P 500 up here. But what I wanted you to note that I'm watching most closely on these charts is, you know, the relative highs here, the highs of price, the highest tops, and where price is now. So notice you've got RSP, that's an equal weight of the S&P 500. It is topped that April-May all-time high. And we've continued to see new all-time highs made. We're coming back now, pulling back toward that top. When you look at the 400 and the 600, look at the margin, especially on the S&P 600, between the highest top we saw all the way back last summer and now where we're trading right now. And that's why that relative strength line on the Russell 2000 looks so ugly, and we're seeing those relative lows. We're not getting much improvement here either on the price for the 400 and the 600. Then you look at the Dow, which we saw was an outperformer, and at its all-time high from back in April, we're seeing a nice move off of that. And then as well, the NASDAQ 100 made a new high back that April-May, and it is now above that. So I thought that would be a good overall view of the market in our technical news and headlines, but I'm going to go ahead and move into our scooter mover of the day. Some of you might recognize this from yesterday. It's a new trading model I'm coming up with called the pink line. The pink line being a chandelier exit, and the blue line being a 50-day simple moving average. And what we were looking at as far as that model or system goes is you want to entry right when you start to see that breakout above both the pink and blue lines. But you do want to be careful because you don't really want the 50-day moving average to still be moving lower. In this case, yes, it is. However, look at what happened here, what's going on with that PMO. We're getting a nice confirmation. We just are getting that buy signal on the move today. And then, of course, being that scooter mover that it is today, with that healthy move to the upside, not quite in the hot zone, but certainly making its way there. I think that ConAgra actually has some pretty good upside potential at this point. I would just be a little bit leery of that 50-day simple moving average still moving lower. All right, and that is your scooter mover of the day, ConAgra Brands.
Very good, and that actually is a very attractive chart. I have to agree with you on that. Looks quite attractive. We're going to move right into upgrades and downgrades, and surprisingly, we had a number of upgrades today. A lot of names to go through. The first one here is Canopy Growth, CGC, one of the marijuana stocks, and we can see that it has been in a declining phase. Today's upgrade, it's up about 2%, but the stock certainly still has work to do before turning positive. These guys are not due to really come in with any earnings until 2021. But interestingly, near term, it is rallying a bit. I'd say it's going to find resistance at that 37. We're not in positive territory with that one. Let's take a look at an energy stock that got upgraded today by Bank of America. This is ConocoPhillips, COP. Energy stocks really suffering. And today, Erin talked about these oil dropping. We're seeing a bit in the way of oversupply of oil, and it's impacting these stocks. We can see that this is in a downtrend, trying to reverse, but not looking particularly healthy. Another upgrade today was C-Trip. These guys have been in a bit of a downtrend. Let's take a look and see how they are doing given the upgrade today. The stock is actually looking quite attractive, and it's similar to that CAG. It's breaking up above that 50-day simple moving average. Your RSI is trending upward, your MACD just above that net neutral zero. So it's up about 3% on the upgrade, looking as if it is very clearly reversing that May downtrend. Hershey, big cap in the consumer staple stocks, was upgraded today. This company is going through a bit of a turnaround. They've slashed they've done a lot in the way of cost cutting, and they've also been in the acquisition phase, and their analysts like it. We can see this nice gap up here, the RSI quite positive, your MACD having that black line up through the red in positive action, and this gap up here is on volume, and you like to see that. That means institutions are believing it. Take a look at this former gap up here at the end of April. This is what you're going to want to look at for as far as a buying entry point, this pullback to that 10-day simple moving average. Quite simply, the stock is overbought. We're getting up here above that 70. So look for a pullback on Hershey. We can move to a home building stock. And Erin mentioned today that the starts really just aren't coming in, but this is KBH really acting quite nicely. The stock is poised to break out of this 2-month base. We can see the RSI is positive, as is that MACD. So I would argue for this particular home builder looking quite attractive. Let's take a look at a semiconductor stock that was upgraded today. And semi stocks have really been on the move, and that is our poll today. They're up about 11.5% over the last 30 days, but this stock has not been a participant in that rally, not until today. It's up 10.5%. Gap up here, pushing the stock up above these simple moving averages in bullish action, and we are getting very, very big volume, which is quite constructive. A last name on the upgrade side is a software stock. This is Progress, PRGS. This has been another leading area, software stocks. This is another stock that has not been participating. It's not attractive so much from my work. There are plenty of other high growth stocks. It is getting a nice boost today, up about 5% on the upgrade. So we could see continued near-term upside in this stock. Let's move on to a couple of the downgrades today. And this one, of course, all about earnings. big loser, CSX rail stock, down almost 11%, now down below this 200-day simple moving average. Huge volume. Look for further distribution on that name. We can take a look at another stock that got hit earlier this month on earnings. This is Levi Strauss, and the stock got hit yet again today, down about 6%. All of your simple moving averages trending downward. RSI, MACD in negative territory. MSI is another company that did get downgraded today. I would argue, however, that the stock's behaving really quite well. There was an initial dip. Buyers are coming in on that dip if it's able to stop. This is Motorola Solutions, MSI. If it's able to close above that 10-day simple moving average, that would be quite bullish for this stock. One last name on the downgrade side, NUS. The company came out, slashed their guidance due to China, a reduced move or income from China. The stock already had been in a very confirmed downtrend. We can see all these simple moving averages, the general direction of the stock, but it's down 17% on the news, huge volume. And that is it for the upgrades and downgrades. We will be right back with Martin Pring.
Today's market volatility provides savvy traders and active investors with an abundance of profitable opportunities. At the Traders Expo Chicago, July 21st through 23rd, dozens of the most respected traders in the world, including Rick Santelli, John Najarian, Tom Sosnoff, Linda Rashke, and Ralph Acampora, will explain how they're adapting their strategies and share the specific trading opportunities they've identified in equities, commodities, forex, futures, and cryptocurrencies. Claim your free pass to join them at chicagotradersexpo.com.
StockCharts is unique because we combine the commentary, the education, as well as the tools in which you need in order to analyze the markets.
The human component around it with all the commentators that we have. I mean, look at the lineup with Murphy and Pring and Morris. These are household names in the industry. They're all tied to StockCharts.
People are always surprised with how many tools are on there that they didn't know about. 5 or 6 different methods for finding relative strength, as an example.
Not only do we have these really great chart tools, but we have this amazing chart school, and you have these shows, and you have all these ways that you can learn.
All right, we are back here at MarketWatchers Live. I have the pleasure to introduce Martin Pring, and most of you know him as one of the tech titans out there. He has written numerous books, especially the one I really loved, Technical Analysis Explained. I would have to say, Martin, it's one of the Bibles of technical analysis.
Yeah, thanks,
How are you
Erin.
doing? Are you ready to give us this presentation?
Absolutely.
All right, let's take it away. I will be watching the chat room if you do have questions. So bring them in, and I will get them into Martin as I can.
Okay, thanks, Erin.
Mm-hmm.
So the title of my talk today is Long-Term Momentum for Profitable Sector Allocations. I don't think it's a great title, but I think you'll find that the content is more appealing, especially when we get to the very end of the presentation, where we'll feature the current situation. So the traditional way to look at long-term momentum is to observe when the indicator moves to an overstretched position and wait for it to reverse. That's what these arrows show, these basic primary trend turning points, as they offer both good and they offer bad primary trend buy and sell signals. We know, for example, that up here, where the KST is high and reversing to the downside, that should be a good selling opportunity for the S&P. But what about the individual sectors? What are they doing? Well, that's the subject of what we're going to try and do today. And there are 2 benefits from looking at this analysis of not just looking at where the S&P is, but where all the individual sectors are in terms of the long-term momentum. The first is to characterize the phase of the cycle by observing the position of the various sectors to see if we can paint a picture of the maturity of the cycle. And to give you a kind of an example here, if I'm walking down a country road and I can see that the leaves are just starting to come out and the blossoms are emerging, these are signs that tell me that the current season is spring. We can do the same thing for the sector analysis at these various turning points in the market. So let's just take a look at one of my a theoretical example here of a long-term KST. I like to split the KST into 4 different quadrants, which I call seasonal momentum. So we start off with the fall when the momentum indicator is declining, but it's declining at a slow. It's rising. The momentum indicator is falling, but it's falling at the actual price is still rising, but rising at a slower and slower pace, which is what's indicated by the momentum. And that is traditionally a period when we're getting distribution, a topping out phase, and maybe even a bit of a markdown phase in the market, or the indicator or the security that we're following. Then it transitions into the winter phase, which is as bad as you can get. And because in a seasonal sense, the winter, of course, is the coldest period, and that's really when you can't really grow any crops. But as we move into spring, things improve. Well, the same thing is true of the market. When the momentum keeps coming down and then starts to bottom out and start to turn up, then that tells you you're in the spring phase, which suggests that prices are likely to move higher and you weather the worst storm. And then finally, we get into summer, which is the market phase, and it is obviously very positive indeed. So what we're going to do is to try and look at these various sectors. We observe where the S&P is. So what we're going to do is to observe where the various sectors are to see if they characterize, if they support the idea that we're in the spring or we're in the summer or in the winter phase. So let's just take a look at this chart here, which compares the S&P to a long-term KST. And what we're going to do is to take a look at this period just here, which was the low in 2003. If you look at the KST for the S&P, it was down in the winter phase and just started to turn up into spring. And we'd already experienced a 2-year drop between 2000 and October of 2002, or March of 2003, which is where this higher low is. And so we know where the S&P is. It's down here. But what were the various groups doing? So that by looking at the various groups and industry groups and sectors, we can see or get a better appreciation of what the character of the market is and whether it's consistent with a bear market low. Because if it is a bear market low, we would expect to see a lot of groups with KSTs in this position right here, so that we have a strong foundation for a rally. So here's our theoretical long-term KST here, split into the 4 quadrants. And in all these points where I'm going to be talking about, or areas, I'm going to have certain sectors which I'm going to label with a red arrow. These are early cycle leaders. And those tend to be the sectors that do well the early part of the cycle. They're defensive, they're interest sensitive, and high dividend paying, and so on and so forth. And then the other sector of the market is the late cycle leaders, the ones that do well when capacity constraints are strong, or when we have a lot of capacity constraints, commodity prices are running, and the system is relatively tight. They tend to do better at the tail end of the cycle when we're at that point. So I would be splitting them into those two areas. Some may argue that some of the ones I picked as early cycle leaders really aren't, but I'm just trying to get an overall impression of what's going on. Again, looking at this kind of seasonality that's going on. So we saw already that the S&P was in a buying mode, down below zero and starting to turn up. So let's take a look at the early cycle leaders and see what they were doing. One of the things that you want for a solid foundation for a bull market is a lot of sectors that are in this area here, in the winter sector and in the spring phase. And that's definitely what we see in this particular case. Now we put up the lagging sectors. I went a little bit too quickly there, I think. We put up the lagging sectors. You see that they are also in a similar situation because it's just the end of a 2-year bear market. They also were in a very strong position. So we're in a very strong position, not only with the S&P to rally, but with all the various components here. One of the other things you can learn from looking at this stuff is that sometimes you can see something unusual happening. What's unusual happening in this particular instance in the bottom of 2003, if you recall, that was just before the housing boom of 2004, 2005, 2006. And guess who's leading the market higher here? Home builders, which will obviously benefit from a booming housing market. So home builders usually are a leading group, but in this case here, they're clearly leading the pack. So next one to look at is we're going to look at a top now. And this time we're looking at the top in 2007. And here we're going to see a completely different type of pattern taking place, because what we would expect at the bottom is what we saw in 2003, which is a lot of sectors congregated in the winter and spring position. Now, if we're looking at a top, we should see more sectors concentrated in the fall area, as the S&P is. So here's the top here, and here's the S&P rolling over to the downside. So we should expect to see a lot of indicators or sectors in that position. And so we can put our S&P in there, which we already saw from the previous chart. It's up in a distributive area. And when we look at the leading groups or the early cycle groups, what we see is they are leading the S&P down. And it's a great reminder that the S&P is really a coincident indicator of the stock market. There are some sectors that fall before it, as we got in red here, and some sectors which fall behind it. And as you can see here, the lagging sectors we had this cluster of leading sectors all the way down here, starting with our home builders. And once again, don't forget, we're just about to enter the housing crisis or the housing bust. And what's leading the market down here is basically the home builders. But I was going to point out that the leading sectors are clustered around here, and then the lagging sectors are following behind. Generally speaking, you can't say that this happens in every cycle, because obviously we got healthcare here, which is a defensive area, in my view, lagging some of the lagging sectors. But basically the lagging sectors as a group are lagging the leading sectors because they're later to turn down. And even these over here are actually lagging because they've got to, in order to come down, they have to finish going up. So definitely there's a consistent situation here between the coincident indicators on the S&P and the leading and the lagging groups. So now we're moving on to a slightly different period. This is 2014, and in July, in fact. And once again, we're seeing at that period there, the S&P is starting to, or the KST is starting to turn down here. So that we turn to July 2014, which is a period when the bull market was in a maturing phase. And at that time, we were several months away from the 2015-2016 mini bear market. And so we'd expect to see a slightly different pattern than at the bottom and at the top here. So it shouldn't be an obvious buying or selling situation, but a kind of more of a mixed situation in terms of where these sectors are, with a bias, obviously, because the prices were still going to move up for a few more months here until they moved into this mini bear market or consolidation phase. We should expect to see maybe a bias, a slight bias on the bullish side, but on balance, more mixed. So let's see what we see. Here we have bonds bottoming out down here in the spring section, and the S&P still in the summer section, but getting towards, or summer phase, but still getting towards the peaking out period. And then finally, we have industrial commodities, which are in a buy mode. So let's take a look at the individual groups. So that the industrial commodities, I should say, that are just starting to turn up, should indicate that we get several groups which are sensitive to commodity prices like energy and so forth, and mines, looking to be in a strong period, because one of the things we look for is to see what bonds are doing and what the early cycle stuff is doing to make sure they're consistent. So when bonds are rallying, for example, utilities should be rallying, and when bonds are falling in price, utilities should be falling, and so forth. And the same thing will be true in industrial commodity prices. If they are showing signs of weakness, then we'd expect to see commodity-related sectors doing the same thing. So let's take a look at these early cycle utilities, early cycle sectors. I said utilities because they were the electric utilities were the first ones to come up. And you can see that they were way ahead of the bond market in this case here. Bear in mind, once again, where we were in the cycle at this point here. We were sort of around here with the S&P, with the actual prices due to move up for the next 6 months or so, and then go into this sideways trading range. So bearing in mind again that the S&P is a coincident indicator, here are the leading indicators or the leading sectors, and they're all dropping down on the curve in the fall position. So then we follow up with the lagging sectors, and then we see once again that the lagging sectors are fairly consistent with what's going on with industrial commodity prices here, because most of them are in the market phase. So what I said before was, you're expecting, with the benefit of hindsight, we know that the market moved up for the next 4 to 6 months, and that was a kind of maturing phase. So here we're seeing a maturing characterization of all these groups, with the lagging groups in the market phase and the leading groups in a kind of the distribution phase. So that was pretty consistent, and the bulk of these sectors are still in the market phase. So that allowed the market to move higher, and that's where we saw the S&P. So now we'll take a look at coming out of this mini bear market that we talked about, the 2015-2016 bear market. And you can see with the KST fell and started to turn up, but it didn't experience one of these major buying situations that we saw in 2003 and 2009. It didn't correct as much. So let's take a look and see what the makeup is at that point there.
Martin,
yeah.
I did get a question. They were wondering what your long-term KST parameters was, because you were just showing a monthly chart. You changed.
Yeah, actually, the best way of doing that is to Google KST in StockCharts, and there's an article on the KST with all the parameters in. But to come down, I mean, it's quite a complicated formula because you have to combine 4 different rates of change and then take 4 different moving averages and combine them into one indicator. But the principal components are 9 months, 12 months, 18 months, and 24 months. But to get a fuller account of it, go and Google, not Google, but
Chart School.
Chart School, that's right. Search in Chart School for KST, and it'll all be revealed.
Excellent, thank you.
So we're talking about October 2016, when we're coming out of this mini bear market. You see the S&P at that point was positioned in the market in the early market phase. And then we're looking at the industrial commodities, also started to look a little stronger here, just getting into the spring phase. And so here are the early cycle leaders. And once again, you know, bonds and utilities are basically doing the same thing. So that's what we want to do. If we're bullish on bonds or bearish on bonds, you want to make sure that the utilities and some of these defensive areas are kind of agreeing on what's going on. You're never going to get total agreement, but the more that agree, more sectors that agree with what should be happening with bonds, or if we're looking at lagging sectors and commodities, the stronger the case, the greater the probability that you're going to be correct. So
all right, more questions just for you. Let's see. In the chart you had up, the 2014 and 2018, he was wondering, he or she, if you see a negative divergence with the KST. Do you use those divergences frequently?
We can go back. You're talking about this chart here?
Yes. And I guess 2014 and 2018.
Yeah, there's a negative divergence. usually use the KST from a point of view of as a long-term smooth indicator or momentum indicator that tries to tell us where we are in terms of the phase of the cycle. So obviously when it's oversold and down here and starting to turn up, that's a bullish situation. And it continues until the curve starts to turn down and cross below its moving average. So that's the main way in which it's used. Obviously, it's not perfect because over here in 1998, as you would find with a lot of these long-term smooth momentum indicators, we had an extended uptrend. And you're always going to get an unduly long lead when you get an extended uptrend because we're assuming the 4-year cycle is still operative here. And if it's not, then that's not going to work. So we'd also use the KST as well with the divergence analysis. And divergence, you want to make sure is always confirmed by a break in the price, either with a moving average crossover or with some kind of a trend line violation or with some kind of a price pattern completion. On shorter term momentum indicators or on the KST, when we're looking at the daily KST, we can actually draw, sometimes occasionally we can draw trend lines as well. So you would interpret the KST as you would with any other momentum indicator, except that the best way to use the KST is to look at this indicator in relation to how overextended it is and when it crosses its, in this case, 9-month moving average. Does that answer the question?
I think so. And then just a quickie based on what you're talking about with your seasons. They're wondering, do you think that Dow theory is dead?
I don't pay a lot of attention to the Dow theory anymore. I don't think it's dead. But the problem is it's kind of like Elliott wave. It's so subject to interpretation. You could always make it work afterwards. That's not a problem. But it's in real time is when it counts. And I look at the Dow theory as one other indicator. And so if I got 5 different indicators, I get to 20% weighting or something of that nature.
All right.
So I wouldn't rule it out completely, but I don't have a strong opinion of that it's as useful as it probably should be.
Got it.
Okay, now let's get on to where I was. Hold on there. There we go. Okay, I think I had the lagging up. This is October 2016 coming out of the mini bear market. And one of the points I was making was that at that point there, industrial commodities had begun a bull market. They were in a spring position. And things like materials and energy, oil and gas, metals, all things which respond to industrial commodities were all consistent with what industrial commodities were saying. So we had and we also had a very high concentration on the right-hand part of the diagram, which is obviously bullish. We don't want to have too many things on the left-hand side. Occasionally we're going to get them, but when we're on the right-hand side, that's much better. Now, sometimes what can happen, I've sort of implied that you go from the fall down into the winter, but sometimes what happens is you come from the fall and then it ticks up from above zero. And we'll see that probably in the next chart that I show you. And that means that instead of going from fall to winter to spring to summer, you get what I call an Indian summer, where you go from fall, where the curve turns up and you have to put it over on this side, into summer. So that's what I call an Indian summer move. So here's our diagram again, and here's an example of where you had an Indian summer, where the or actually over here on 216 is an even better example, where it didn't quite come down to zero and started to move up. So it went really from a fall position just here to a summer position just here, because remember, summer is when it's rising and above zero, and that's what that is. So now we're going to take a look at earlier this year, in February of this year, and see what's happening. And as you can see from the S&P, it was in a declining phase in February of this year, above zero. And bonds were in a bullish phase because they just started to turn up into spring. So let's take a look at the industrial commodity prices were still still coming down. They were in the winter position. So when we look at the early cycle leaders, what we're seeing is that there's kind of a bit of a mixed bag. Some are in the spring, summer positive area on the right-hand part of the diagram, and some are in the negative left-hand part of the diagram. But by and large, what we had, even though the S&P was in this position here of being in the fall, several leading groups were in a position of being in the spring and summer. So let's take a look and see where the lagging stuff was. And one of the things you can notice here is that lagging was very heavily concentrated in the fall section. So while some of the sectors were in a position to rally here, most of the sectors were in a position where they were needing to have some corrective activity and move down into the winter position, or alternatively cross from fall into summer. And what we actually saw with prices, so on balance, it kind of suggested that we needed some corrective activity. Well, what happened, if you can't remember, between February and June, which is going to be our next slide, was that the S&P worked its way higher, and then in May came back to where it was in February. So basically, it went sideways. So it corrected by going sideways. And that's what happened to all these groups. So I'm going to take a look and see also from the second point I'm trying to bring up. The first one is we're looking at the characterization of the market and where we might be in the overall cycle. And then the second thing, of course, is we want to make some money. So which are the most likely groups to make money between February and June? So what I've got next is a perf chart that looks at all of these sectors here from the end of February to, I think it was middle of July. And I can't see it. It's 10th of July, I guess it was. So here are all these sectors that we saw in the early part of the cycle. We're in the winter, or we're in the spring or summer quadrant on the right-hand part of the chart. Here's the S&P, and you can see most of them did, in fact, outperform. One that didn't was this one here, which was the telecom. But all the other sectors there that we're looking at all outperform the S&P composite. So that kind of way, we wouldn't expect everything to work every time on every cycle. But in terms of consistency, the ones that we would have picked out earlier in the year were the ones that actually outperformed the S&P. We can take a look at the same data in a different format, where we take the S&P in black and we have a horizontal line here at its performance. And you can see most of these groups, with the exception of the telecom, outperformed the S&P composite above this orange horizontal line. And then we can do the same at that February peak and see what's happened to the fall candidates. So once again, we'll highlight the S&P right here, and the red line corresponds to the performance of the S&P. So anything below it underperforms, which is what we would expect. So most of these groups, this one here, what's that? The Dow Jones Transports, this one's the materials, this one over here is metals and so forth. Most of these, 1, 2, 3, 4, 5, 6, underperformed the S&P, which is what we would have expected because they're on the left-hand part of the diagram. And then we got these two here, technology and semiconductors, which buck the trend. Again, I'm pointing out that this doesn't work 100% of the time, but it puts the odds in your favor. And now we're going to take a look at the current situation, where we can see that in July 15th, the S&P was moving sideways, hadn't started to turn, it was moving sideways. So is this another buying opportunity? Well, sometimes we have to take a look at other indicators apart from the long-term KST. And in this case here, I'm looking at the same period, a bit longer period, the Comerica indicator. And the Comerica, when it turns to the upside from below zero, is giving us our buy signal. And you can see that generally speaking, when it turns, it means what it says. You don't get too many, when it's below zero, you don't get too many jagged instances. Here's one over here, of course, a failed signal back in 2002. But fast forward to the present, it's giving us a buy signal now by ever so gently starting to turn up. So that suggests to me that we don't always take the KST as our lone indicator. That suggests to me that we need to look at some other indicators as well. And a copper, which is more sensitive and more subject to whipsaws, I'll grant you, is giving us a buy signal here. And then an even more reliable indicator, I think, is this PPO, using a 6-month and a 25-month and a 15-month parameter. And the vertical lines represent the buy signals when it turns up from zero. And we've had 22 positive or valid buy signals and 2 failed signals marked by the dashed red line. Look where it is right now. It's definitely reversed to the upside. This could be a whipsaw, but looking at the history of the chart, looking at the number of valid signals versus the number of failed signals, seems to me the odds are pretty strong that we're in one of these buying situations. So let's finally take a look at the schematic diagram again with our sectors. So first thing to go up is bonds. They're positive, just a little bit above zero. And I should point out, when you could look at this position, you obviously think, or you naturally think, that bonds could continue rallying up right up to this level here and then start to turn down in a kind of natural way. But there's nothing to stop bonds from turning down from here or from turning down from there. We don't know what's going to happen, but once they start to turn to the downside, that tells us we're in a different phase of the cycle. But right now, it's not overbought, and it's in a positive position for bonds. With the S&P, what I've got is a question mark as to whether or not the S&P, which is going sideways, may be branching off to move over here into the summer position. Maybe we're going to have an Indian summer with the S&P, because as we move on to this chart, I'll show you that several of the groups have already moved over on an Indian summer basis from where they were in February to where they are now. So there's industrial commodity prices. In February, they were here, and now they've progressed a little bit more. So I'm looking for industrial commodity prices to start to turn around at this point. But until we get some trend confirming signals, we have to assume that the momentum and the trend of industrial commodities is still down. So then we're going to look up at our early cycle and late cycle leaders. And here's the early cycle. And remember, there were a few of them clustered around here and slightly above zero back in February. Well, now they've all kind of transitioned and they moved to a higher level. And when we look at the lagging sectors, most of them were in the left-hand part of the chart in the fall and winter. But you can see what's happened. Industrials, for example, which was over here in February, has now had an Indian summer and transition. Same thing with semiconductors and technology. So it seems to me that we have a lot of sectors which are now positioned right where that PPO is and where the copper indicator was in terms of a new cycle where we can get a markup to higher levels. So I think I've pretty well run out of my time here, guys. So if you have any other questions.
You wrapped it up very nice. The last question I guess I would have for you from the room is that whether you've back tested the KST, just, how far, what kind of results do you feel like you get?
Never actually back tested it, basically because I would never dream of using the KST on its own. I would always use it in terms of other indicators, because it assumes certain cyclical behavior, which happens most of the time. But say about 20% of the time, it doesn't have that cyclical behavior where you get that elongated cycle or you get a truncated cycle. So I don't think you want to use it as an indicator to buy or sell, just as one indication in an overall approach.
Sure. And then are you strictly technicals, or do you actually look at some of the macro or fundamentals as well?
Well, I look at the economy. I don't look at individual fundamentals of stocks and things. And right now, I've got a couple of leading indicators for the economy, which are giving me buy signals for the stock market. I don't have them with me today, but they've been pretty consistent in the past. You've got to look at certain indicators which are sort of sensitive to what the stock market's doing, as opposed to just taking something like non-farm payrolls or something like that, which has very little predictive value as far as the stock market itself is concerned.
All right, excellent. Well, we really, really appreciate you coming on to the show today. I know all of our viewers were very excited about it, as were Mary Ellen and I, to be honest. So,
Yes.
It's been
so
my
I'm gonna wish you a good day and farewell. And again, thank you so much for being here.
okay. Thank you.
All right. That was Martin Pring. My goodness, I just love listening to his views there, and that I've always been intrigued by that seasonal chart. Sort of reminds me a little bit of an RRG, but certainly not really telling us the same thing. So
Yeah, certainly the long view, and love the historical precedent as far as taking us back to bear market periods, the emergence out of that, and really giving some intelligence to where we are now as far as going forward.
yes, excellent. All right, Bill, I do know it is time for the 10 and 10.
Very good.
All right. There we go. I had to blow the dust out of my mouse. It didn't want to move right. All right. Well, I know our first symbol is going to be Bank of America. Since I had a little extra time, I went ahead and annotated it. You know, people have, again, I'm still intrigued by this new system. I haven't back tested it. I haven't even tweaked it to what I want it to be. But I thought I'd annotate this one in that pink line sort of system or model. And, you know, really what it's telling me right now, here's just where your entry points would be, and, you know, your exits. And, you know, obviously not perfect. Somebody had pointed out Starbucks, and yeah, you would have sold it at the end of May, but, you know, 4 days later, it'd have you enter again. Well, I know that's for some people, their trading accounts, that's just not, doesn't work for them. So I'm trying to figure out some of these other indicators. But in any case, based on this, I wouldn't be I wouldn't be buying it just on this particular model, because the 50-day simple moving average is moving lower. However, if I put it on my own chart style that I have had, I like the way the PMO is acting. It is not overbought. We're still in this trading range, though. I would really like to see it get out above that before I would get in, because it is at the top of that range, which means if it wants to stay in that range, it's the next place to go is down. So I would just keep an eye on that. If you have it, I'd hold it based on the PMO. I would probably not make an entry at this point, though. All
Very
right.
good. Yeah, the next one is Federal Express, FDX. Those transports getting hit today. Interesting to see.
Indeed. All right. Well, obviously, this is all about annotation. So handy dandy auto support resistance. You know, this one had us a little bit fooled here, because we did get the breakout above that short-term overhead resistance. You also could make a case here, I believe. Let me get a color here that you can see. You could make a case for a possible ascending triangle here. And, you know, that was what would have executed that triangle, but then it fell right back down in it. I still think there's a lot of promise here, just because the PMO is still rising, but the caveat I'd make is that it is still below zero. If I owned it, I'd still hold it. If I didn't, I wouldn't get in it until I saw a more decisive breakout above that overhead resistance.
Okay, next one. Some of these software stocks are putting in a good show today, and this is SHOP, Shopify.
Yes, indeed. Not that I know anything about shopping. All right, so let's go ahead, and again, I'm going to annotate this. We're trying to show you in the 10 and 10 segment really how quickly and easily you can annotate a chart and, you know, make some conclusions out of it. Now, you know, at first I was looking at this symmetrical triangle formation, but you know, I don't like to see these sorts of patterns go too far into the apex, but it is doing what you would expect it to do, which is break to the upside. If I get out the auto support resistance here and we look at the the high we had back here, getting very close to that overhead resistance. That would concern me just a wee bit there. You do have the PMO trying to turn up, but overall it is still in decline. We're getting that loss of momentum somewhat, but you're seeing a pretty even upside acceleration, and that usually will flatten or lower the PMO. But in general, I don't like seeing that, from here on out, we've been really looking at, negative momentum. So not something I like, but wow, you can definitely make. This is pretty nice, though, seeing a scooter that's been in the hot zone since the beginning of the year. I think that gives you a little bit better comfort if you are to get in. I would probably want to wait, like I said, for that breakout above 340. If I had it, I'd hold it. If I didn't, I would want to see a little bit more upside momentum, along with a possible breakout above that 340 level.
Very good. And the next one is also having a good day. The ticker is FNV. This is Franco Nevada, a gold silver stock.
Okay, here we go. FNB.
Oh, V as in Victor.
V as Victor. Okay. There we go.
A little different chart there.
Yeah, slightly different there, I would have to say. I guess one of the things I'd be a little bit worried about is the flattening of the PMO. It's not really being very decisive, but it wants to go down. It wants to break down and give us that sell signal. Right now, it's trying to whipsaw back into a buy signal, but as you can see, it's really still at the top of its range. Go ahead and mark that in here. Oops, I don't want that kind of line. Okay, so you can see it's really at the top of that range for the PMO, but at the same time, we've seen it get as low as, almost -5. So we have a little bit more room here that we could accommodate, but nice little breakout, I have to say. I like that. And again, I think this one would be more of a trading zone. You can see we got the gap up, fell back down, did not cover the gap. And I thought I would say that's positive, staying above the 20-day EMA. And like I said, really trying to break out today. I think if I was holding it, I would certainly hold it longer. I don't think that I would get in. I know this looks fairly strong right now, but I just don't like the fact that PMO is still a little bit on the overbought side.
Very good. Another stock here is TTD Trade Desk.
All right.
They were big winner last year and
okay.
This year as well.
Quickly, let's see. We'll go ahead and use arrows right now. Don't like the PMO trying to turn down below its signal line, but overall it is looking like it might curl to the upside, and it is above the 0 line, which is a positive. Auto support resistance. There's, of course, your overhead resistance. Some of these are pretty easy to figure out. In the shorter term, that would be your low at around 220. If you're looking for a possible midway or intermediary area of support, I think you could make a case for the top here and the low back here. But I'm not as convinced about that. I'd be more interested here. We're about halfway up through this trading range, and I like the way the OBV is acting here. Let's go ahead and move that here. So that's great. And then the scooter, of course, is, it's been in the hot zone pretty much all year. So I think it looks pretty good. If I had it, I'd hold it. I don't think I would buy it until I knew that PMO was going to turn back to the upside.
Very good. And another software stock that's having a really nice downtrend reversal is Palo Alto, PANW.
PANW. All right. Wow. Nice looking chart, huh? This one is, I would go with the chasing analogy here a little bit, but I think there's still more upside potential. You got a double bottom, and I can say that because we did get the breakout above the confirmation line right there. You're supposed to expect a move about the length of that pattern to the upside. That's a nice little 20-point move. So that would put you right up. Let's see, I'll copy that right a little bit below 235 there, maybe 234. So that would be your upside target. You could get in now just because the PMO is just now starting to make its way above that zero line. I would certainly hold on to it. Yeah, I could consider a buy here, but I would have been looking at that a little bit earlier with the PMO starting to rise nicely after that breakout above the confirmation point.
Very good. And then we have Match.com, MTCH.
All right. There we are. Let's go annotate. How many we got left? I just want to make sure I don't get too long.
Oh, we have 3 more.
All right. That's doable. All right, trading range, pretty clear. And we're now just starting to see that PMO turn to the upside. The OBV seems to be rising nicely to confirm this move to the upside. Well, I mean, again, you've got a nice happy scooter here. It's been in the hot zone or just below since last year, the end of last year. You know, I like this one. I could see getting in. Again, you're in a trading range and you're at the top of it. For me, I just like to see a little bit more. I want to know that momentum's really there, that I'm going to get the breakout. You know, if I'm going to try and trade a trading range and then expect an upside move, I'd want to be a little bit further back here where you had the PMO turning up. So, but you know, I don't know. It's not too late. But if if you have it, I'd hold it. If you haven't, I would be lukewarm on a purchase here.
Very interesting. Yeah, we have a lot of momentum type stocks, DLTR, that are just at their breakout points. Yeah. This is Dollar Tree.
I can always tell a lot of times when people use one of my scans or how they pick some of these symbols. I always find that interesting. I'm like, I just saw that. All right, let's go ahead. We'll do a trend line here. And we've got declining tops, and we haven't quite made that move out. Again, I suppose you could draw a symmetrical triangle here, but it's awfully close to that apex. But even so, we're supposed to expect that upside breakout. But you notice the PMO is a little bit having some problems there. And yeah, you know, not bad as far as the scooter goes. But you know, if I had it, I'd hold it. I don't think that I would be selling it. I would want to see that PMO turn up in a more oh gosh, what is the word?
Defined fashion.
Defined fashion with a little more energy behind it, you know, a little more excitement.
Yeah,
that would be it.
Very good. Then we have another cannabis stock, ACB. This was also initiated with a buy rating today.
Oh, okay. I kind of could agree with that one. Let's get down to the nitty gritty. All right, here's pretty much quite a defined declining tops trend line here. I would want to see it break out above that. You've got the PMO is showing promise, not going to lie. But you know what? It's been kind of a tease for quite a while. So I would want to get that. In this case, I would probably want either a breakout above that declining tops trend line or a PMO that does give me a buy signal, just because it hasn't been, it's not twitchy. It's just not been making that exciting move to the upside, I guess.
Okay, this last one is a topic that we're going to be discussing in Chartwise Women, and it's GOLD, and lots of earnings estimates being revised upward for this one.
Yeah, and you know, gold is a great space right now. I would just be really worried about this overbought PMO right now. You know, +6, granted we've seen -6, but that means it's still overbought. You know, gold is, I get the feeling it's sort of in this holding pattern a little bit. It had to really digest that really nice move to the upside. Right now, I see an ascending wedge. That's, you know, the expectation is a breakdown. And like I said, it's really overbought. If I had it, I would really be considering selling it right now. just because it's really at the top right now of the range. Gold is looking to pull back a little bit. That PMO is just so overbought that worries me. Volume also is not moving the right direction to me. Those tops are declining on the OBV, and they're about even or rising on price.
Very good.
And all of these are already in the MarketWatchers live chart list. So you can go in there right now and go take a look at my annotations and agree or disagree with them, whatever you'd like. All right, we'll be right back after this. All right, it is time for our final market update. Let's get a grasp on what has been going on so far today in the market. We're looking at all of the indexes moving down. If you look at our market overview, you'll see everything in the red. Dow is lower, almost 47 points. S&P down almost 9 points right now. We're seeing the NASDAQ down 0.12%. And the New York Stock Exchange is down a little over a 0.25%. Mid caps and small caps certainly not participating, but did make up for some pretty serious losses earlier this morning, unfortunately heading back down toward them. Treasury yields continue to move lower. Now we're getting a reading of 2.068%. VIX is higher on the day, 1319, still a rather complacent reading. UUP lower on the day, trying to make a comeback here at the intraday lows. Gold having a fabulous day, forming an intraday flag. We could see even more upside later today or tomorrow. USO is making new intraday lows, not a good sign. And then TLT bonds, nice big move to the upside and continuing higher. Not a surprise given what our treasury yields look like right now. And that is the final market update. It is time to move into some sector rotation. And we will just take a really quick look on that. I'm just going to show you what I'm seeing on the, here we go, on our sector summary. And I think you can do all of this on one page, and it really gives you a great feel for what the market's doing, and that familiarity with utilities, healthcare being in that defensive area, staples as well. But then we have technology is hanging in there with utilities and healthcare still on the positive side. I do like to see that. That is a more aggressive fund. But, and you've got discretionary. It's not the big loser today. Right now, the industrials, as Mary Ellen had mentioned earlier, really taking a beating today, down over 1.5%. But what I like to look at is the rotation from the past week and from the past month. I like to look at these different time frames because it gives you an understanding of what's been going on in the market. We've had, when we see some decline, you would expect to see materials actually, these are sort of mid-range with the discretionary. So really the rally has been, looks like over the past week, we're really not seeing anything overly interesting, except that I would say real estate and energy really still taking it on the chin there. You can also go to a 1-month look, and what has rotation been looking like? All of these are aggressive sectors. So the rally of the past month is being led by those aggressive sectors. That's a good thing to see. It usually suggests that you're going to see more upside potential. And this is a 1-month reading. So that's more of an intermediate term look, a little bit less short term. And then finally, I want to look at a sector perf chart. And you can do the same thing, only it's a little more visual, I guess I could say. And when you go to that perf chart, you do get that cycle, that rotation that we talk about, that Martin actually talked about a little bit as well. So you can get a feel for what, if you're seeing leading in materials and staples and energy, that's really the market top. So you really don't want to see those leading to the upside. So if you watch these two bars as you move back, you can see when we ended up with those starting to lead, and when did that occur? Well, let's see, back here in a little bit over 200 days ago, April. So really back in the 19th of April of 2018, we were starting to finally see those categories perk up. So that's what you kind of can keep an eye on as far as the sector rotation goes. And Mary Ellen, I'm going to pass it to you and give me your thoughts on sector.
Yeah, you bet. Absolutely. What I'm going to do is go ahead and focus on how you can use StockCharts.com to really wrap your arms around sector rotation. And Erin certainly showed you that sector summary page. I'm going to spend a minute there as well. But what we're looking at here is the candle glance view, and you can get this from that initial interface page on StockCharts.com. And what I've done here, you can, of course, put ticker symbols. I've gone ahead and put in the broader market indices as well as these various sectors. So XLK is technology. We have financials, industrials, and also communications and consumer discretionary, as well as gold. And from there, I've gone in and put an indicator. You can add the indicator of your choice, whether it's going to be money flow related. I like to put in the RSI. I want to see that relative strength indicator turning positive, and then you can sort it descending. So let's go ahead and take a look at where we are. These are 2-month thumbnail views of these different indices as well as the broader markets ranked from strength to weakness. So up in the forefront, we do have the Dow showing up. The Dow is putting in quite a good show, certainly month to date, followed by discretionary. Now, this is a different view. Erin did point out that we have strength in the discretionary technology area, and then surprisingly, consumer staples. We're seeing quite a bit of continued strength there. And then as we drill down beyond these various sectors, this is that weakness in that Russell 2000. So down in the lower right quartile, these are your less strong areas. And of course, industrials are getting hit today, but they had been lagging for some time. These transport stocks were lagging. They perked up earlier in the week and are lagging again, but the industrials certainly here. So that is how you can use that candle glance to really get in front of, wrap your arms around, again, strength to weakness among these sectors. Now I'm going to do something that is unusual for me. This is not something I would do, but for really super short-term traders, and this is an intraday, we're looking at 2-day charts, again, populated by those various sectors. And I have not refreshed it. So the information that is here, and I'll go ahead and refresh it, but this is from a couple of hours ago. This is the view on the open. Of course, the market dropped. Same RSI. This is going to be, again, a shorter term view of where the strength is over the last 2 days. And we can see this is that big drop in industrials. So now I'm going to go ahead and refresh it because this is giving you that view from a couple of hours ago, this big gap up here in gold. So for those of you that are faster traders, for lack of a better word, this may help you in your selection as far as where to then drill down and research further. So this is a more updated view, and we can see that the Russell did attempt to reverse but is faltering again. But let's take a look at some of these sectors. What I did want to point out to you is financials really started the day in negative territory. They did have this reversal attempt, but notice how these simple moving averages still are going to help you. Financials are stabilizing here, finding upside resistance, but this shorter term view, and I believe Erin uses it as well, is going to be instructive as far as pointing you toward areas of strength or weakness over the last very recent period. So let's go back and take a quick look here at the sector view. And what we are looking for here is the I talked about, and Erin did show this as well, this is that 1 month view. So it's not going to be for the month of July. It's going to be over the last 30 days. So over the last 30 days, we are seeing that strength. Technology, communication services, this is going to be Facebook, Netflix, a lot of these FANG stocks, consumer discretionary, and I will reiterate what Erin already said, super bullish to see strength in these areas. These are your faster growing areas by nature. You want these to be leading, and it is bullish for a continuation of the current uptrend. All very interesting insight, because then down on the lower quartile over the last 30 days, we're seeing relative weakness in these defensive areas, consumer staples, healthcare, utilities, and real estate. So net last 30 days action in the broader markets is bullish, very constructive. Now let's take this a bit further and drill down, and we can look within and among technology. And this is going to tie in with our survey for today. We talked about these semiconductor stocks that are up 11.5%. And Martin Pring very astutely pointed out the fact that not only technology is at late cycle, but semiconductors. And semiconductors are very, very cyclical. These stocks have a lot of dynamics that are unique to them. They're going to be dependent upon capital increases in capital spending, ups and downs. There's a lot of supply and demand factors in play here. Let's take a look at the semiconductor index. I'm going to pull it up over here. This is a monthly view, and we can see going back historically, it's had these great periods of outperformance. But take a look at this choppiness. Now, of course, that's the bear market at the end of last year. But let's take a look this year, and you can see the dynamics shifting a bit. Unlike these nice orderly uptrends, the simple moving average I have here is a 6-month simple moving average. This is what you like to see, but more recently, it's getting a bit sloppier, and a lot of dynamics that are important to know about among these semiconductors, and that is their relationship with China. They're very tied in. Pretty much every semiconductor company that's US based is going to have a large, or at least some portion of their revenues that are derived from the Chinese market. So uncertainty with the US-China relationships has this group skittish, if you will. And then I talked about supply and demand dynamics. So these chip providers, it's going to be all about, is there an oversupply, and equally important and relative, is there enough in the way of demand to drive these chip stocks higher? And indeed, there are a lot in the way of technological advances and dynamics that would support the case for demand. The first, of course, is 5G, those network expansions that are taking place worldwide. And then we also have personal computers are still being advancing in their technological shifts. AI is another, smartphones. So there's a lot in the way of dynamics that would support a continued uptrend.
Nice. And I know if you go take the poll, that's something we will be talking about, if I remember correctly, as semiconductors. But boy,
and then, yeah.
It is time. We need to move on to the scooter report. It'll just be a quickie, but I think we probably should show you some of our StockCharts Technical Rank, what is going on. Okay, so let's go ahead and we're going to do our final segment here. And I'm just going to show you very quickly the top 10 right now with the highest technical ranks in the large caps. And what I like to do is pull up my candle glance, because I can see my PMO, the price momentum oscillator, and I can see the way the price is moving in relation to the 20 and 50-day EMAs. And you can see why these are really in that top 10. But you know what would worry me is to look at the ones that are starting to lose that momentum. They may still have a high scooter, but you can see they have this sort of topping look to them. And, you know, if you pull them up, there you go, there's one. There you can see we are starting to top out with price as well. And in the thumbnail, it's even more obvious because we keep getting lower highs. and declining tops trend lines. And that does suggest we could see a move down on Cadence Design. And I know it's in that software space. I know it's been doing well, but that would be something I would just be paying attention to if I owned it. And Synopsys, looking at that, it's really similar situation. Now, you could start making that case for a bull flag on both of these. Like I said, if I owned it, I would just be watching it a little more closely than I was before. What do you got for the scooter report?
Okay, I can certainly go ahead and take a look at that scooter report and see what we can uncover here. So let's go ahead to this initial interface here. And in this dashboard area, you can go ahead and look at these scooter rankings. And we can see oftentimes when you do the mid cap and small cap, you'll get these huge moves that aren't going to be quite as relevant. But let's take a look at ASML. And this is a stock that, of course, is in that semiconductor space. It is smaller cap, so you're going to get these gaps up. The volume is a little bit light, but the stock is powering to new highs, huge volume, and I would look for a pullback on this one. But that is certainly a way that you can use the scooter report. I can go ahead back and take a very quick look at the larger cap, because that is going to have a bit more in the way of relevance and not quite as fast moving, if you will. And again, with an eye toward the semiconductor space, AMCR. And we can see actually that is not a semiconductor stock. It's a packaging stock that does not look particularly healthy. But yeah, so that's how you would use the scooter report to your benefit.
Yeah, it is so handy. And like I said, I love that candle glance. I love, like you were showing, you could just click right away and see, why are these guys moving so high? And remember, the scooter is really it kind of leans toward the intermediate to long term. So something to consider. Here is our poll. Everybody's looking for continued strength out of the semiconductors. I actually said no, because I just think that we might see strength in different industry groups, at least, that would lead technology. I mean, I still am in favor of software.
Over semiconductors, yes.
Yep.
And then I would urge individuals, I didn't quite get to that, but if you use StockCharts.com, go to technology, go to semiconductors, sort that list by scooter. And those names up in the forefront are your leadership names. You can shop around in that 75 area for names just coming into favor, but really super powerful, that scooter rating. Again, if you're looking, those of you that think that it is going to outperform over the next couple of months, that'd be a great fishing grounds.
Excellent. Okay. Wow, another show. We're halfway through, only 2 more together, but we do have a show together this afternoon. It will be at 3 p.m. Eastern, noon Pacific, Chartwise Women. I know we've got some great stuff lined up to show you today, and I don't know, should I give them any kind of tease on what we're going to cover?
Well, certainly we talked about all that glitters. We have a lot of wisdom of the day. So we're going to share some insights that are going to build on the last 2 weeks, all with an eye toward a simplified system for our viewers.
Yes, that should be great. I'm going to really insist that I really want to have some of you take a peek at it. And honestly, we do try and make it a little bit more accessible to our beginner audience. We don't want to throw around a lot of acronyms. We still are debuting that pink line system. I'm still tweaking it. I'm still trying to back test it and see what different things will make it better. But yeah, 3 p.m. Eastern today. Watch us live, both of us, Chartwise Women, for sure.
Very good.
Yeah, I'm pretty excited about that. All right. I'm going to have to close this out, though. Again, Mary Ellen, thanks for filling in for Tom this week. That's a lot of work. I do know that. But I do want to thank all of you for being with us today. I do want you to complete that survey if you could. It's just to the right of the viewer when you leave. We really like to get that feedback, and we do seriously read every single comment. As a quick reminder, we air 5 days a week, Mondays through Fridays, noon to 1:30 p.m. Eastern. Have a great afternoon, everyone, and we'll see you back here tomorrow. Happy trading.